Good evening. Our team has decided to do the next event at Hyderabad on the 28th of October, around about 4:30 to 5 in the evening. It's a Saturday. Those desirous of meeting me in Hyderabad at the event may contact the email given below, moneypagehyderabad@gmail.com. We have also given WhatsApp numbers. You can contact us there. My team will be happy to help you with the details.
Hi guys, welcome back to Be Rich. I managed to pull Shashwat in for a change today. I managed to get Anand a couple of days for you guys. And today I got Shashwat into our new studio. New setup at least. Same old studio, but a new table and a new kind of an environment. And I want to get Shashwat's opinion about it. What do you think about this, man?
It looks really nice.
I think this is a wonderful statue to have. It's constantly keep reminding us of what he said.
Definitely.
Yeah.
And there's a nice Tirukural where he says that knowledge is like digging a well. The deeper you dig, the more knowledge springs out, like how water springs out the deeper you dig. So, on that note, we can talk about the kind of digging we're going to be doing today.
Yes. And I'm going to be digging this so much because I get to spend some time with Shashwat, who I haven't seen for a long time. So enjoy.
Yeah.
So what are we talking about today, Shashwat?
So today we're going to be talking about time diversification and Paul Samuelson. And for those of you who don't know who Paul Samuelson is, he's one of the most formidable economists who we've seen in this discipline. And he basically worked to formalize mathematics in the discipline of economics. And if today economics is where it is in terms of the discipline and how people perceive it, it's because of Paul Samuelson and his phenomenal work he's done over a couple of decades. So that's Paul Samuelson for you. And he's talked in detail about a lot of economics concepts, but today we're going to be focusing on time diversification as an economics concept. And this plays into investing. So we're going to be looking at this. It's deeply tied into behavioral economics as well.
Yes, it's not about time travel or space continuum as some of you might think.
It's actually not as complicated as it may sound.
Yes.
So stick with us, bear with us, and in maybe another 10-15 minutes, you should also be up to speed. And
yes.
Yeah.
Though it sounds technical, it's something very useful for all of you out there.
Yes. So let's get started on what this whole thing even is. So as an investor, you have a few choices. First, you have to decide what your time horizon is. Ideally, we suggest that you invest for the long term always. However, we do know that most of you have different sorts of goals, and it's not very easy to always invest for the long term. And some of you may be investing to be able to purchase a bike or a car, or maybe pay off an education loan, or so on and so forth. So these are different goals. And that being said, right off the bat today, while I went to get a coffee with my uncle, we got a message talking about whether I should pay off a loan or continue investing, that kind of a question. First,
what was the situation was that person had taken a loan and he's paying the EMI for that loan.
Yeah.
Meanwhile, some of his salary, since he's been watching Anand's video, he's started investing and he's been investing for some time. So he reached out to me and Shashwat saying, I have a loan which is a tremendous burden on me and I'm finding it hard, but I've been doing the right things of investing. How do I get rid of this loan is what he asked, and Shashwat gave him some advice.
Yeah, the simple solution can be summarized in a sentence. Basically, pay off the loan. That's the only thing you need to do right now. Investing comes second. To be in debt is to be at someone else's mercy. And that is not a place where any of us wants to be. And you want to be at your own mercy and your own whims and fancies, not some not some bank officer. That being said, so there are many different goals you guys have in terms of investing. So some of you might have a shorter period of investment. So you might prefer to have something which is less volatile, or as you guys say, less risky. But we don't believe in the conventional notion of risk. We don't think volatility is risk. And Paul Samuelson also talks about this. So stocks in the long run are it's like a weighing scale, the stock market, like what Warren Buffett says, and my uncle has also said. Stock markets in the long run are like a weighing scale. In the short run, it's like an election machine. In the sense that in the short run, you don't know which way it's going to swing. However, in the long run, it's like a weighing scale in the sense that that is the intrinsic value and that's where it's going to be. So this is what we've observed in the markets, and stock market returns have always beaten bonds over the long term. And we've made multiple videos on why this is and this entire phenomenon. So that being said, still a lot of you invest in bonds. Why is that so? Because you guys are afraid of volatility and you want liquidity. And this is something which stocks and bonds may or may not give. So a lot of you invest in FDs as well, even though FDs give you inferior returns compared to both these avenues of investment. But what we have to say is that time diversification, in the sense that having some investments which are for the short term, like an FD, and then having some investments which are for the medium term, like suppose a few stocks, and the long term, like retirement bonds or so, this may not be the best strategy for most in terms of just pure returns. Because as we know, if your length of runway is long enough, then you should be able to put a lot of your investment allocation into stocks which have guaranteed superior returns over the long run. And this is something which has plagued many economists over years. It's called the equity premium puzzle, which is, the question is this: if stocks have been known to beat bonds in terms of returns, why are people still buying bonds for the long term? Well, the answer is obvious. People are risk averse, and people don't look at the investment in a long time frame. They look at it in a narrow frame setting. That is, they look at it from day to day, month to month, year to year, so on and so forth. They don't look at it as a decade, 2 decades, 3 decades, a lifetime. They don't look at it that way. That's why time diversification makes sense to some people, in the sense that they choose to have certain investments in certain period time frames. However, if you actually look at it, you should be framing your investments in a broad framing, in the sense that you should be looking at your entire time horizon. If you are 20 right now, like I am, then you need to be looking at, if you're a healthy 20-year-old and you don't have any comorbidities at this age, which I hope most of you don't, you should be able to look at another 60 years of life ahead of you, at least bare minimum.
Yes.
And if you're 40, then another 40 years. And if you're 50, then another 30 years. Those of you who are 50, you have almost half your life ahead of you, little less than half your life ahead of you. So a lot of you have a lot of time. Most of you have a lot of time, and you should be dealing with it as such. You shouldn't narrowly frame, because if you narrowly frame, you give up on enormous returns in the long run. So if your stocks are giving you 15% compounded return year on year, whereas your bonds are yielding you 10% and your FDs are yielding you 5 or 6%, yes, over 1 or 2 years, it may not make that much of a difference, and your stock might go up and down. But over the period of 20 or 30 years, what you'll see is that your FD is lagging way behind your Nifty index fund, or albeit your S&P 500, or any of your other metrics. And you can very much fact check me and look at the returns over a period of time and compound your FD at 4 or 6%. Take 6% if you want. But the idea here is that it's very lucrative to be able to frame things in a broad way, and time diversification doesn't make too much sense, because an asset doesn't become a bad asset in the short run and great asset in the long run. An asset is an asset, and it's going to give you the same amount of expected returns. However, in the short run, there may be more volatility, but that shouldn't bother you, because you shouldn't be selling it in the first place. So that's where I stand on time diversification as a concept, and Paul Samuelson sort of agrees with me as well.
Okay, so this is how do you apply this? So what does this mean to you as an investor, especially a novice investor, who most of you are, who are following this channel? And so these are the considerations you should take. One, if you don't like volatility, then stay in bonds. But we don't advise you to. We advise you to embrace a little bit of uncertainty in life, because life is very uncertain. So a bit of uncertainty, a bit of volatility is not going to be bad for you. And when you're considering time frames, if the investment is for short term, you need the returns, the capital back to you for something short, let's say in a time span less than 5 years. So you need something, the cash return to you in 2 years time for something which you plan to do, a big purchase you plan to do, then look at it in terms of bonds. If the time horizon is longer than 5 years and you're able to keep it longer than 5 years, then we suggest being in the stock market, because the returns compared to bonds will be far superior, is what Shashwat has been saying. Stock market gives you an average of 10% or more if you are looking at the long term and if you have invested wisely and correctly. And another key takeaway what Shashwat is saying is, if you're even at the age of 50, you still have another 30 years ahead of you. Even if you have comorbidities, the way medical science is evolving and the way the world is evolving, you'll definitely live past the age of 80 plus. So considering the fact that you have another 30 years, even if you're 50, you should have some appetite to be in the stock market. As far as even if you're 80, I would say, if you have another 5-6 years ahead of you, at that point in your life, volatility is not bad for you, and you can be in the stock market and you can absorb that kind of volatility and take some returns which will be good for you. This is the main idea of what this whole conversation is about, how you should view your investments considering time horizons and not be stifled. Like Shashwat said, most of us are scared of losing capital, and we think keeping the money in FD, we can reach and grab it whenever we want. That is giving slightly more than my savings account, which is okay. It's not, because when you take it to inflation, you're constantly eroding the money. You might as well keep the money on your table in your house instead of putting it in an FD, because it's not growing. The imaginary number which is coming, it's not growing. You're constantly losing. The percentage of loss may be different, but you're losing. So at least move it into a bond instrument, so you're beating inflation, or move it into stock investment. Yes, compared to an FD, withdrawing funds of a bond or withdrawing funds from a stock may not be as immediate as an FD. I do agree on that. But if you manage your life well and you manage your finances well, I'm sure you'll be able to diversify yourself such that you do have some funds, liquid funds, in case of an emergency, but at the same time you can invest wisely. The only emergencies which are there, which are so critical you'll need cash for immediately, is medical emergencies. All other emergencies, including buying a flat or buying an asset of another class, or even a expenditure of your nature which is not an asset class, like going on a holiday or buying a car, you can plan it well ahead. It suddenly doesn't creep up on you that you're going to go on a holiday today or going on a holiday 1 month from now. You do know most of the times that even if someone's getting married, it is 6 months away and you need to travel to that destination. You do know you have enough ample time. Or you need to buy a car or plan to buy a house and you're saving towards that. You do know when it's coming and how it's coming. So you can accordingly move your funds at that point of time and liquidate your positions and keep your funds ready for that investment or that spend. So do consider what Shashwat is saying, to have a little bit of an appetite for volatility and to play in the market. So at least you're beating inflation. If you're not beating inflation, you're losing, and you're losing at the end, and it's a terrible pain to suffer when you've worked all your life very hard through a career of 30-40 years, and to reach that age of 60, like Shashwat's age is 20, when he retires at the age of 60-65, when you stand there and you realize
You have nothing to go back on.
Nothing to go back on. And the one asset which you cannot get back in life is time. Even money you can make. Like I spoke in that other podcast about Anil Goyal in Chennai, from the age of 41, in 30 years, how from very little capital he became 2,200 crore plus. It's possible to achieve wealth even in a very short span of time, even late in life. But time is something you cannot get back. So please do invest your time wisely and think about whatever Shashwat has said. Anything else you want to add, Shashwat?
No, it's just that, yes, volatility might be painful, but there are ways to mitigate the pain coming from volatility, stemming from volatility. One of the ways is not to look at your portfolio, to trust the process, keep investing in the right way. Once you have the system locked down, then you don't need to worry about what's happening. That's one way to reduce out of sight, out of mind. That's the adage which goes and applies over here. And another thing is that the price you pay to avoid a little bit of volatility is an enormous amount of returns. And this volatility is, in effect, harmless to you over the long run. Yes, in the short run, it might make your liquidity situation a little sticky. I'm not debating that. However, in the long run, you should be compensated for this lack of liquidity in the short run by an enormous amount. And stocks are liquid. It's just that when they're in the red, so to speak, you may not be able to cash it out, or you may not want to, you shouldn't cash it out. And that is a price you have to pay in the short run. But in the long run, you will be compensated handsomely for this trade-off which you're making. And it's not much of a trade-off if you look at it in the long run. Think about it. We've done the SIP calculations. You can put in any percentage you like. All the information is online. And you know how the Nifty's performed over the past 10 years, past 20 years. You can plug in the numbers and see what kind of returns you'll be missing out on. If you compound an FD at the same price, at the same rate, and you compound a Nifty 50 at the rate at which the Nifty grows, and you'll be shocked by the enormous returns you're missing out on, just because you're scared about a little volatility in the short run. It's a lot.
And I strongly advise you not to just go on based on what Anand says, Like one person was messaging saying that Anand was speaking about Wipro few cycles back. Now he's not talking about Wipro. Should I sell my Wipro holdings? And I have large holdings. I found that very funny because I was like, why are you investing? And he told me it's for the long horizon. I'm very young. And I said, why are you worried? Has the fundamentals of Wipro changed? No. You cannot be buying, selling stocks or investing in mutual funds on and off just based on what people on YouTube or even Anand is saying on and off. You have to do your research. I can't stress this over and over again. Please employ a financial advisor. Please talk to someone who's registered with SEBI. Find out the right information. Take your time and do the research. Just because we have said this, suddenly don't wake up and say, I'm running out of time and run. There is time. There is time. And value investing is about moving slowly and patiently. It's about slowly starting your engine, going from first gear to second gear to third gear to fourth gear. It's not about slamming on the accelerator, letting your engine rev and burning rubber on the road. We are not that. So take your time. Do find this as a wake-up call if you've been napping and sleeping on the wheel. Take this opportunity to read more, research more, and go talk more and find someone who's a registered advisor next to you, close to you, and talk to them. Knowledge is always king. Knowledge is what makes you wealthy, not money.
Yeah. And the purpose of these videos is educational purely, and we aren't SEBI registered advisors, neither is my other uncle. And you guys shouldn't base your investment decisions off of us. You should be consulting, as my uncle said, you should be consulting a SEBI registered advisor. These videos are made to, increase awareness and sort of dispel fear amongst all of you, because there's this big feeling of FOMO which is going around that, you're missing out on something. You have a lot of time. Take your time with your decision and make a good one. No point jumping into it.
Correct. That being said, I hope you enjoyed the video today, and we will try and pull Shashwat in some more as and when he's near the studio or remotely when he's in college. Thank you for watching the video today, and see you in the next one.
Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.